Welcome to March Market Review. In this month review, we'll be covering 3 points. Firstly, we will be talking about March performance as usual. And secondly, because it's the end of the first quarter, we will be doing a wrap-up of how has our portfolio and the indexes have done so far in the first quarter. And finally, as a series of covering major economies equity landscape, I'll be talking about Japanese equity landscape this month and let everyone have a better understanding of what is going on there. Now, firstly, let's go into the March market performance. And you can see here, right now in front of me, what we are looking at is a table that compares the sector allocation of dimensional global core equity and as well as the MSCI World equity weight. As you can see from this comparison between these two indexes, we can see the different weights of each sector that they have put in. Now, if we look closely, we can see that for dimensional global core equity, the financials, industrial, energy, and materials have an overweight. Now, because of this value sector, value tilt, it actually has an overweight in this sector. And particularly, you can see industrial, energy, and material. Dimensional global core equity has a much higher weight compared to the MSCI World weight. For example, the industrial in dimensional global core equity has about 14.43% relative to the MSCI World weight, which has 11.12% in industrial. Now, if we look into what is going on in this sector, we can compare using the S&P 500 sector performance to understand the sector's performance. Okay. Now, the S&P 500 is the top 500 US companies in US, and as the allocation in US is about 70% for both the dimensional global core equity as well as the MSCI World. Looking at the S&P 500 helps us to better understand what is going on in these sectors. Now, if we look at the IT, healthcare, communications, we can see that the S&P sector performance has been around 0.62%, 2%, and 2.9% respectively. Now, these are positive performance, yes, but in March, the average equity has went up about 3.2%. In fact, MSCI World Index actually went up about that amount. Similarly, the S&P 500 also went up by 3.2%. If we continue to look at other sectors, the financial, industrial, energy, and material, you can see that the S&P 500 sector performance in this sector has been higher than 3.2%, which is higher than average. Financials, 4.4%, industrial, 4.1%, and energy, 9.6%, and materials, about 6.1%. Now, because the dimensional global core equity overweights in this sector, in March, we are seeing that dimensional equity actually outperformed the market indexes quite substantially, in fact. Okay, to be fair, what we are looking just now is actually at the S&P 500, which is the top 500 US companies. If we want to look at the whole of the US performance and see if actually value has outperformed growth, we can look at the iShares Russell 2000, which is the bottom 2,000 listed companies in US, as well as the iShares Russell 1000, which is the top 1,000 companies in US. Now, these 3,000 companies makes up the whole of the US, almost the whole of the US listed companies. If we compare their value companies and the growth companies, we can see for the bottom 2,000 companies in the iShares Russell 2000, value has actually outperformed growth. And again, in the top 1,000, iShares Russell 1000, value again outperformed growth. And as a result, we can see that from here, and as well as the S&P 500, US value companies have actually outperformed growth. Looking at the dimensional equities fund, you can see across the dimensional world equity, the dimensional global core equity, and dimensional global targeted value, they have actually outperformed the market index's average of 3.2% because value has done well. And particularly, the global targeted value went up about 5.2%. That's because it is the most value-tilted fund of all the three funds. Now let's look at the Q1 performance. Now in the developed market, as shown as for the MSCI World IMI Index, you can see that it has went up about 8.4% for the past 3 months. And comparatively, while the emerging market has also went up quite a bit, 2.2%, it is compared to the developed market, it has underperformed. Now, as a result, the MSCI All Country World, which has a 90% developed market allocation and 10% in emerging market, is slightly lesser than the MSCI World. Now, if we look at the Bloomberg Global Aggregate Bond Index, it barely moved. Why is this so? Now, firstly, the Bloomberg Global Aggregate has a composition of both government bonds as well as corporate bonds. Now, government treasury yields have risen year to date. However, the corporate spread in the corporate bonds has actually came down. As a result, the decrease in the corporate spread has actually net off the rise in the US Treasury yield. And we can see that the Bloomberg Global Aggregate Bond Index barely moved year to date. Next, looking at the Amundi funds, year-to-date performance, the Amundi Index MSCI World Index Emerging Market and Global Aggregate Bond Index tracks what I mentioned about in the market indexes. Next, let's look at dimensional funds year-to-date performance. Firstly, equity funds. Dimensional World Equity, Global Core Equity, Emerging Market Large Cap Core, and Global Targeted Value all has a very strong performance. 7.7%, 8.2%, 2.5%, and 5.2%. Now, particularly, you can see that the dimensional global targeted value year-to-date performance is similar to the March performance. Why is this so? Because for the first 2 months, global targeted value barely moved. But because in March, value did so well that the global targeted value actually went up to 5.2%. Going into fixed income, dimensional global core fixed income actually did better than the Bloomberg Global Aggregate. 0.2% for the dimensional fixed income global core equity versus 0% for Bloomberg Global Aggregate. Going into the shorter duration funds, the dimensional global short fixed income and the dimensional global short-term investment grade went up by 1.3% and 1% respectively. In terms of country weight allocation in equity funds, Japan is the second largest. That's why it is important for us to look into what is going on in Japan's equity landscape. Okay. If we look at the global major indexes, year-to-date performance, we can see that Japan's two major index, Nikkei 225 and TOPIX, has risen by 20.6% and 17% comparatively to their other global major index counterparts. S&P 500 10.2%, Stock 600 Europe 7%, Kospi South Korea 3.4%, CSI China 3.1%, Hang Seng Index 3%, and Sensex India about 2%. Why is Japan outperforming its global major indexes so much? There are three reasons for this. Firstly, corporate earnings in Japan has risen sharply. The rising AI trend has benefited Tokyo Electron, and their earnings have actually risen sharply. Also, because of the depreciating yen, the export companies in Japan benefited from rising exports and sees increase in revenue as well. Companies like Toyota actually reported earnings that beat estimation. Now, second point, because of rising geopolitical risks, investors are now reallocating their funds from China into Japan. If we look at this chart, the cumulative flow of foreign investors' funds between January 2023 to March 2024, you can see there's a huge influx of foreign funds that has risen into Japan. And as of December 2023 to March 2024, the foreign inflow funds rose about 3 trillion yen. Thirdly, Japan's government introduced measures to improve corporate governance and capital efficiency to enhance shareholder value, and consequently, Tokyo Stock Exchange, as of January, require listed companies to improve long-term returns, profitability, as well as companies' valuation. And failure to meet these rules might result in listed companies getting delisted. To conclude, the 3 points that lead to Japan's sharp rise in equity performance year to date. Firstly, strong corporate earnings. Second, high inflow of foreign funds. And thirdly, better corporate governance to enhance shareholder value. Now that we have looked into the year-to-date performance, let's take an analytic view on what is going on with the outlook of Japan's equity landscape. Now, remember the first point that I mentioned, because of the rise in corporate earnings, part of the contribution was due to depreciating yen. Now, because Japan has scarce land as well as energy resources, the depreciating yen actually led to a rising cost in oil and food, which Japan is a net importer of. And as a result of that, Japanese households has actually experienced a sharp rise in inflation. In fact, 3.1%, which is above the average of the past 20 years of 2%. By right, actually, the rise in inflation is something that the Japan government and the Bank of Japan is hoping for. But that is only if the inflation is contributed by a rise in consumption demand. What we are seeing is that the Japan's consumption activity for the past 2 decades, has been relatively stagnant. As you can see from this chart, the 100 being no change in growth in consumption activity, the consumption activity since January 2003 to January 2004, you can see it's hovering about the 100 point of index, which means that consumption activity has barely increased or decreased. Now, that's because the inflation doesn't come from the consumption demand, but a rise in input prices. Like I mentioned, Japan being a net importer of food and crude oil leads to a household and as well as a depreciating of yen, leads to a household experiencing a sharp rise in inflation. Now, furthermore, because for the past few decades, Japan has actually seen wages barely increasing since late 1990s. In fact, if you can see, it went as low, Japanese wage growth went as low as 1.6%. It's only recently that you can see that the wage growth has risen to 3.6%. Now, this sharp rise, I'll cover later, but if we look at the past decades, this means that a lack of consumption activity and a stagnant wage growth means that the real GDP growth has actually been stagnant. Now, in fact, if you look at Japan's real GDP growth, since 1993, it has actually barely moved out, on average, out of the 0% growth. So, since the rising inflation is such a bad thing, Why is the market showing a contrasting narrative that it is rising? Now, this is because while the inflation rate is due to supply-driven reasons and not consumption demand, there's one thing that came out well. For decades, Japan's inflation expectation within Japanese household has been kept at very low percentage. Now, what we're seeing now is that Japan's inflation expectation has risen. If you look at this chart, which is a survey held by Bank of Japan, where they ask Japanese household what they see the price level like in 1 year from now. In other words, they are surveying this Japanese household, trying to understand the inflation rate expectation 1 year from now. And you can see, since 2021 quarter one, the expectation that inflation will go up significantly 1 year from now is only 5.8%, while in 2023 quarter four, it has actually risen up to 23%. So this sharp rise is about 3 times as much increase that inflation 1 year from now will actually go up significantly. In other words, the expectation of inflation has risen. And because of this rise in inflation expectation, consumers would actually demand higher wage from their employers, and employers would actually, to meet the rising costs of their employees, will raise goods and services and keep prices higher, and therefore bringing up consumers' inflation expectation over more. And this leads to a wage price spiral and keeps inflation rising. Now, how is this a good thing? There are 2 reasons why Japan's equity can benefit in the rise in inflation expectation over time. Firstly, yes, as I mentioned, consumers will demand a higher wage from companies, and because of that, companies might see a rise in employees' cost. Now, to cover those costs, companies will need to raise prices, goods and services price, but at the same time, it also boosts consumer confidence, and therefore higher spending, which would lead to higher earnings for companies that supply these goods and services. At the same time, investor sentiment will improve and raise share prices. Now, in fact, right, the recent labor union actually negotiated an increase of 5.6% in 2024 with the largest companies the labor union group actually negotiated a wage hike of 5.6% in 2024 with the largest companies in Japan. And we can see that, just now I mentioned that the wage rise in 2023 was actually 3.6%. So you can see an eventual growth in wage rising. And in fact, because of this, it actually shows the point 1 that this would improve consumer confidence and lead to a rise in investor sentiment and therefore a rise in share price. Now, the second point is that because of this rise in inflation expectations, savers may not see putting their money in deposits as the inflation rate might erode their purchasing power, and they might find a better venue to improve their value, to improve or preserve the value of their purchasing power, and this might also benefit stocks. In fact, we are already seeing Japanese households embracing investment in the equity landscape. With the introduction of tax-free measures through the NISA individual savings account reform, which encourages Japanese households to invest in equity, we are seeing a rising increase of investment through this account, which is the NISA account. If you look at the Japanese Investment Trust Association report, the net inflows into Japanese stock investment trust has risen sharply. As you can see, in December 2023, the inflows into Japan stocks investments has actually been about 2 billion yen and has risen to 1.4 trillion yen in January. And this majority of this rise is actually attributed to the Japanese households from the NISA account. Furthermore, right now, Japanese households are sitting at a 7 trillion US dollar currency and deposits. If you look at the distribution household assets in Japan versus Europe and US, as of June 1st, 2023, Japan has about $14 trillion in individual assets, and more than half of them, about 54%, is in currency and deposits. Now, comparatively, if we look at the Euro area, it's about 33% in currency and deposits. If Japan's currency and deposit is to align with Europe from 54% to 33%, BlackRock estimates there will be an inflow of funds of 1.7 trillion USD into Japan equity. Okay, finally, let's have a summary of Japan's equity landscape. The points that I've covered, Japan's stock market, yes, they have faced challenge because of rising inflation and stagnant consumer spending. But at the same time, because of this rising inflation, it has actually led to a rising expectation of inflation outlook. And this actually led to improved wage growth and investment patterns, hinting at potential developments for Japan's equity future. Finally, diversification remains essential for managing risk and capturing returns. With our significant equity exposure to Japan, we are well positioned to capture whatever emerging opportunities arising from that market. Let me pass the time to Joyce, who will also be talking more about diversification as well. Thank you.
Thank you, Chun Chong, for a very comprehensive market review. My name is Joyce, Client Advisor at Providend. So as Chun Chong has pointed out, that values showed stronger performance in March, but it is also important to note that there will be disappointing periods where the value stocks didn't do well. But empirical data has shows that value stocks in the US have consistently outperformed the growth stocks. So in this chart, we are looking at the yearly observations of premiums, value minus growth in US from 1927 to 2022. So we are looking at almost 100 years of data. So the green bars represents the years in which value beat growth, and the yellow bars represents years in which the growth beat value. So what do you observe? So there are more green bars than the yellow, which means that the value stocks often outperform growth stocks, and the value premiums often appear quickly and in large magnitudes on average. Value has outperformed the growth stocks by 4.4% annually in the US since 1927. So value is an asset class, it's not an investment strategy. So the key message here is diversification. So there's no evidence that investors can reliably predict how individual securities or a small handful of securities will perform in any given year. So looking at the broad market, equities generate a return of about 8 to 10%, but technically, there's only a small market that drives the majority of the return. As you can see here, in the period of 1994 to 2021, all stocks worldwide gave about 8.5% return, but if you exclude the top 10%, as you can see here, in the period of 1994 to 2021, all stocks worldwide gave about 8.5% return. But if you exclude the top 10% of the performance each year, the return drops to 4%. And if you exclude the top 25%, it drops to negative. So diversification is important, but it's equally important to cast a wide net to ensure that we capture the upside wherever it appears. So diversification is important, but it's equally important to cast a wide net to ensure that we capture the upside wherever it happens. So that's all for today. So thank you very much. So if you have any questions of what we have discussed today, feel free to write into us. Thank you.